This is HFO's Multifamily Marketwatch, presented by Pacific Exteriors Northwest, a contractor specializing in siding and exterior envelopes, delivering exceptional quality and service for over 30 years. By Aprio, combining DeLapp's Pacific Northwest experience with Aprio's global resources to offer unparalleled tax, wealth management, and advisory services for real estate owners. And by Kennedy Restoration, helping residential and business owners recover from fire, water, mold, and storm damage.
Welcome back to Multifamily Marketwatch. I'm Greg Frick, partner with HFO Investment Real Estate. Today we have with us Matt Dzbanek. He's Senior Director, Global Real Estate Advisors, Capital Services, and also Ariel. Matt, we've had you on before. I know you were at an event last time. Thanks for taking the time to speak to our audience again.
No, of course. Thank you for having me. I'm glad I could be back.
Can you just, for people that didn't see you at our event or haven't, heard, can you give us a little bit about GREA and your role in the capital market side of the business?
Yeah, absolutely. So I am one of the senior directors here at GREA on the capital services side, helping place debt and equity nationwide. We really do coast to coast. We've closed loans in almost all 50 states, and really just helping clients navigate the weird world of financing.
Well, it's interesting you use that word weird, because I think we're feeling the same way in the brokerage side a little bit. It's the uneasiness. How would you describe the financing environment right now for multifamily, kind of nationally, then maybe some of the nuances between different local markets?
Yeah, I would say I use this actually to describe it to someone today, and it's weird in concept, but it's the best way to describe it. It sounds like lenders are very eager to get money out and very eager to be stagnant all at the same time. We're finding that we're seeing more competition. We're seeing more banks enter the market, or I should say re-enter the market. We're seeing people want to put out money. Now, a lot of these lenders might not be pushing proceeds as much as borrowers want. The rates might be a little bit higher, right? The lenders are learning things that they have to adjust to with all of the uncertainty that just happened. But in the flip side, we're seeing lenders put money out. They're putting term sheets out. They want to figure out how to get deals done. And the hardest part is just bringing the lender and the borrower together to get a cohesive deal that both sides like.
Join the HFO community and get weekly multifamily intel. Click to subscribe.
Now, does that surprise you that we're seeing, lenders kind of putting term sheets in? Because again, we haven't seen a big drop in the 10-year. We haven't seen rates, so was that kind of a surprise of where we were last year as to where we are today?
So I think this is where we expected to be. I think it's been slower than most people actually expected. I feel like Every year for the past 5 years, you've heard the same thing. Next year, we're going to hit the ground, right? Next year, it's next year, it's next year.
Yeah,
and I think every year we've gotten progressively better, but we're not at that next year we're up and running. I don't think it's a rate thing. Look, lenders will put out money at rates at 3%. They'll put out money at rates at 10%. I think one of the big hangups was a lot of these lenders had deals on their books that weren't rolling. So it was constraining a lot of their capital. Now, between the sales market picking up and the refinance market picking up, a lot of these banks are having loans roll off their books and now have available capital to put out, right? They're also feeling a lot more confident in the market. They're feeling a lot more confident both in the macro and micro economic pieces of it. So I think there's just a lot of positive momentum, and it's really just about capturing that movement.
Yeah, so now that, like you said, the loans are kind of rolling in, so now they do have capital, fresh capital to put back out. And they're going to loan regardless of where rates are. So speaking of rates, where are you seeing rates landing today or this quarter that you guys have closed?
Yeah, that's a great question. Rates are all over the map. I will say, 5+ years ago, we used to just quote whole rates because the Treasuries never moved. With the movement, we're really starting to quote things index plus spreads. So I'll say we haven't really seen a dramatic shift in the spreads, right? Spreads have sort of stayed in that 175 to 225 over the corresponding Treasury for, I'd say, the past probably like a year or two. So that's been pretty consistent. Where the biggest change is just the Treasuries, and we have deals that started with all-in rates of 575 that are now at 6.25 or 6.5 because the Treasury's gone up 50 to 75 basis points. So for certain people who have to do things, they're swallowing it, they're going forward, they're doing it. But yeah, there's a lot of clients who are putting a pause on things if they don't need to. If their existing lender will buy them time, if they can just sort of eke things out a little bit further. We're definitely seeing. I would say this is probably one of the slower Q2s we've seen in a while.
Yeah, we kind of felt the same way even on the sales side, kind of a ramp up in Q1, and then rates kind of jumped up a little bit. It slowed down. The last 90, 120 days have been a little bit, and again, if they have a forward lock or they've done that, there's some protection there. But if not, they're kind of, rolling the dice of where it's going to end up.
Yeah, exactly. And look, some people have to, right? There are acquisitions that have to get done. There are refis with loans expiring. But we have plenty of business that's sitting on the sideline saying, call me when the Treasuries pick a number.
Now, with more lenders with fresh capital, do you expect third and fourth quarter maybe margins or spreads compress a little bit, or do you think we're going to stay in that, that same kind of range we've been in for the last 12 months on the spread side?
It's another great question. Look, it's funny. I tell the clients this all the time. If I quoted a client 200 over 5-6 years ago, they would have laughed me off the phone and told me I have no idea what's going on. In today's world, 200 over is pretty average, and that's pretty down the middle. So I think we will see spreads compress. I do think spreads will get back. I don't want to say we have not seen a huge spread compression over the past 12 months. They sort of compressed and have stayed stagnant. Where we are seeing the spread compression is actually in the bridge space. In the debt fund space, looking to put out capital, there's a ton of money in that space that are looking to do deals. So that's where we've seen, 2-3 years ago, a 500 to 600 over spread was pretty common. For the right size deal, we have lenders that can be in the 200 to 300 over range. And when you're looking at SOFR versus the Treasuries, we have deals where a bridge loan is actually priced the same as a perm loan within 50 basis points. So we do have a lot of clients who are actually opting to take bridge over perm because it's more flexible, it's non-recourse, it's an easier, quicker close, and your cost of capital actually isn't that dramatically different. So that's been a major shift we've seen over the past, call it 24 months.
And that kind of brought up another question in terms of are you seeing more flexibility in terms and conditions on these loans that are getting, on the bridge space for sure, but on some of the traditional ones, is there some flexibility on prepays, maybe longer interest only, period? What are you seeing in that horizon?
There is definitely more flexibility than there was 12 to 24 months ago. We're still not where we were 5+ years ago. I'd say interest only is starting to make a comeback. It was very tough to get in 23 and 24. 25, we started to see a year, maybe 2 years on a 5-year. We're sort of still staying held there. Prepay, there is definitely some flexibility. I'd say proceeds and rate are where lenders seem to be digging their heels in more so than other terms.
Gotcha. And then on it, last few years, a lot of agency loans and things like that. How are they behaving differently than compared to like banks? I know in debt funds they are, but what's your take on where the agencies are today?
Yeah, the agencies are in a really interesting spot. I don't know how much the listeners follow, but Freddie just got rid of their SBL or small balance program, which has been a real shock to the system. They're really not doing deals sub $2 million anymore, which was a huge piece of their business. And they're really looking at the strength of the sponsor in a lot different light. So what we're seeing is a lot of borrowers who used to be easy yeses in the agency world, who used to easily be able to get term sheets on, there's a lot more questions. They want to understand their management experience. There's a lot more detail that we have to go into. So I think what used to be a sort of no-brainer, cheapest cost of capital, right, in the larger space, you're still seeing them very competitive. But I would say once you get sub $10 million, there's a lot of banks that are just as competitive and a lot easier to deal with and navigate the nuances too.
So their volume is going to be significantly down in that under $10 million space as to where they were, they were dominating the market.
Oh, yeah. It was a huge part of their business. What we've heard is they've increased the cap from last year and they're nowhere near on pace to hit those numbers. That might have changed in the past 30 or 60 days, but we're here, they're very low, which also second half of the year might make them much more incentivized to give pricing waivers, to give interest only, to give more flexibility on different terms. So that's going to be very interesting to see how the agencies really try and increase the volume.
Now, I know, affordability has been a big question. I know at a point, agencies will come in and if there's a naturally occurring affordable, there was some, rate. Are you seeing that with other lenders? Kind of that same kind of on the natural occurring affordable? Or is that more on just the agency side?
It's really an agency term. Every now and then there will be lenders who have certain credits that they need to hit, so they will get a little bit more aggressive. But I would say by and large, that's really just an agency product. We don't really see it in the CMBS or in the banking world too often.
Interesting. And then so you've got clients that have, loans coming due. I mean, what are you telling them to, get in early with the unknown on where, the 10-year, like you said, I think spreads are going to probably stay relatively the same. I mean, what's your kind of recommendation for them as they're looking at options? Hey, I've got a loan that's coming due in, fourth quarter of 26. What's the timing for them to start, getting that process going?
Yeah, look, everything is slow, right? If you have a loan coming due fourth quarter, you should be starting that process now. And I know that sounds crazy, but we were just looking at a deal that we have in our pipeline today that's actually been moving decently fast. We signed term sheets on it February 1st, and we'll probably close next week. That's about a 4 to 5 month close time from signing term sheets. Now, I will say lenders, there are definitely lenders who can move quicker. We have plenty of lenders that are still closing in 60 days. But the truth is, since you don't know who's going to give you the best terms, you want to buy yourself as much time as possible. And in terms of what we advise, a lot of it comes down to term. Right? If you have a loan coming due in Q4, we probably advise starting now. If you have a year, 6, 9, 12 months on your loan, our advice is probably sit and wait and see how things pan out around you. But a lot of it comes down to the needs of the client, and that's really the hard part.
And as you said, the system is still a little gummed up in terms of timing. There are some lenders that can go fast, but you do have to allocate more time than what we're maybe typically used to from a few years ago.
Every bank, I can tell you from internally from our end, and I know this is from your end as well, everyone is incredibly busy right now. Now, are things closing? Are things transacting? That's a different story. But we're all incredibly busy with screenings, with evaluations, with fee agreements, with running around with deals that may or may not go somewhere. And the lenders are feeling that too, right? In terms of volume, they're seeing record volume in terms of intake. That doesn't necessarily mean they're putting out money. Doesn't necessarily mean they are doing a huge amount of business. But if you think about how many deals are out in the market right now between the debt and the sales side, they're seeing all of them. They have to wade through it. They have to make decisions on what they like and what they don't like and have to push through that muck. So I think a lot of it is just there's a lot of activity, but not a lot of closings.
And as you bring up, as the funnel is getting full with all these deals coming in, what separates which ones that are getting financed and which ones are stalling? Is it an operation? Is it sponsor? Is it a combination of both? Where do you see the things that'll make that transaction kind of slow up as it goes through the process?
I would say it's a couple different things, right? The first is borrower expectations versus lender expectations, right? I think that's where it's really important to make sure as a borrower, especially if you have not been borrowing regularly for the past 2 or 3 years, to understand what has changed in the market in terms of rate, pricing, proceeds, terms, right? I feel like a lot of times our clients who have not borrowed in 2 or 3 years, when they see the initial lender matrix, get a little pause and things are different than they're used to. So that's been slowing things up. I would say it's also, right, making sure a lender knows you're real. There's a lot of brokers out there that just sling rent roll and expenses on Excel or who are not putting a package together, right? I can tell you when we get hired and we put a package together and we send it to the market, a lender is going to take it seriously because we took the time and effort to make a package and put our stamp behind it. So, right, working with the right broker, running the process appropriately, making sure people are focused on yours as opposed to the hundreds of other emails they're getting, that's how you really get through these processes.
And how are you guys looking at, in some markets we've seen, negative trade outs on rents. How are you looking forward on things like that where you maybe have a little bit higher vacancy or, I don't want to say concessions. We do think they're burning off, but how are lenders, are they looking at that differently than, they would say in 22, 23?
I don't think they're looking at it differently. I just think there's more of it. Right? In 22 and 23, there really wasn't any rent concessions. Most markets were humming pretty solidly. I would say where we really see a delta is in a lot of markets out there, there is an oversupply issue. There is a rent rediscovery issue. And there are plenty of lenders out there who say, hey, I'm going to put the brakes on this product and let's see how it shakes out. I would say the other lenders really just are trying to look at the past 12 months. Right? How are rents trending? How are concessions trending? and they're trying to make forward-looking decisions based on rear-looking data. So that could be advantageous to someone who has rents trending downwards. A lot of it's going to come down to how aggressive that lender wants to be for those assets and how much they believe that market's hitting the end of supply.
And are you seeing that with some of the, again, it's not in our market here. We don't have a supply glut or anything. We don't, have a lack of supply. Is that driving some lenders? Are you seeing some lenders saying, we're going to wait for the, the markets that had so much supply to kind of, absorb in before we, place more money, or they're just underwriting differently?
It's a mixture of both. We have some lenders who have stepped out of markets. Like I could tell you, as being in New York, right? We had a lot of similar issues to you. We do not have an oversupply issue. We have a governance issue, and we had a lot of people leave our market and go to the Sun Belt, go to the Southwest, right? Markets that are a little more favorable. And while a lot of those people are still there, over the past year or so, we've noticed a huge flood of people coming back to these markets, right? And I think you guys have probably seen the same, where they're looking at it saying, you know what, yes, I have to deal with some more government issue. I have to work through those things, but at least I know it's not a supply demand issue. At least I know I'll be occupied. I can underwrite my rents correctly. So I do think that depending on, as a borrower, how you think about things is going to influence which markets you go to. And I think there will be the guys who say, I'm fine dealing with the government issues. I don't want to have to deal with a demand issue. Other people say, look, I like the Sun Belt. I like the red states. I want lack of government oversight, and I just have to buy at the right basis to make sure that I'm okay.
And you're going to ride that supply demand wave as we get oversupply, then it comes around. So that's, again, in New York, where you guys are, where we are, we're just not seeing that. The deliveries are so far below. It's just a natural where we're just not going to see an oversupply in these markets, some of these markets. So.
Exactly. So look, what I tell people all the time is everywhere in the country is a good investment. It just depends on what issue you want to deal with, right? You can put your money anywhere, but what risk are you willing to take and what kind of return are you willing to get for it?
Yeah, exactly. And what are some of the common mistakes, as a borrower's getting ready either to, refi or do a purchase? I mean, what do you see, if you could give some advice to somebody that's listening to this, to say you're getting ready, you've got a loan coming due, or you want to, acquire some more units. I mean, what do you tell them to get ready that's a little different than where it was a few years ago on the financing side?
I would say we do a lot more digging into our deals and timing. Right. So up front, we're going to look for things like violations, things like arrears reports. If there's any legal nuances in that area that we should be aware of, right? Like rent stabilization in New York, or Section 8 or things of that nature. And then the second is making sure you have enough time, right? There's a lot of clients who still to this day are waiting until the last minute. And some lenders will give small extensions and others won't. And you have to make sure you have enough time, right? The first is to make sure you're sizing it up and you have the right numbers in front of you. Second is making sure that you as a borrower have the right expectations as to what the market is actually offering. So that way, when you get those term sheets, you don't hit a total pause and waste weeks and weeks getting caught up, right? The more diligence you can, as a borrower, can do now, the more conversations you can have, right? Speak to your mortgage broker, speak to your bankers, find someone to have a conversation with, because it grossly impacts how people are looking at deals. And I can't tell you how many times we've been on calls with borrowers who, once they speak to us, either walk away from or pursue deals heavier because we're able to shore up those assumptions for them.
All right, so I think it's just, like you said, it's matching those expectations with the borrowers as to, giving yourself enough time so you can look at options. If you put yourself in such a tight time frame, you're going to have very limited options, and that's not, that's just not usually what their expectation is.
Exactly. And you're running into desperation mode. And the more you can avoid that in today's world, the better.
And then in terms of a couple last questions is, what do you follow, following the market, regarding financing that, other people don't talk about? Or, is it, everybody kind of, see where the 10 year is doing? Are there trends or things that you look at on a, daily or quarterly basis that kind of give you a sense of where we think things are going?
So I think there were, right? Like I think following the Fed meetings every 45 days is important, hearing what they're saying, right? The most recent Fed meeting, they're indicating that there is a good chance that we will actually see rate increases over the next 12 months. I think that's very important. I can't tell you how many people I've spoken to who tell me their assumptions and then they hear the Fed meeting and it's opposite, right? So,
exactly.
So keeping track of that. Where it gets hard is the macro stuff, right? Will another war start with Iran? Will we have other conflicts? Will there be other issues? And that's really where just reading your general newspaper is helpful, right? And understanding how different actions influence treasuries and how they influence different indices, I think is the best way to do it. But I hate to say it, recently there's really no way to track it. Like, we're all just sort of on this roller coaster together, and you just have to make sure you're hanging on tight.
No, exactly. There seems to be like a disconnect between what's happening and what the expectation of what that cause, from the cause and the effect. But there's a disconnect between the effect when we see these events happen. We're like, wait, this is usually what happens. And we either get the opposite, or it's very hard to get a sense of where it's going to go.
Oh, absolutely.
Yeah. Well, again, I want to thank you for taking the time to speak to our audience. I think the biggest message is, if you have a financing need or are going to have one in the future, give Matt a call, but don't wait. Go early. It takes much more time. The system is doing deals, but it's not going at a velocity that I think a lot of people were used to if they haven't done financing in the last couple of years.
Exactly. And yeah, feel free to reach out. I think we can put my phone number and email address on the screen
it'll be
here.
down below. Exactly.
And if you guys need anything, reach out. But the sooner the better. Start the conversation early, understand what your options are, and make good decisions.
Definitely. Well, thanks again. Have a great one, and we'll see you again next time on Multifamily Market Watch.
Appreciate the time.
Thank you.
Talk soon.
HFO's entire office specializes in multifamily real estate, making us the largest multifamily brokerage in the Pacific Northwest. Your success is our passion. Like and subscribe to Multifamily Marketwatch videos on YouTube, articles on LinkedIn, and podcasts on all major streaming markets. Build your legacy with HFO. Call 503-241-5541 or visit our website at hfore.com for more information. HFO is a partner of the Global Real Estate Advisor Network.
Love the insights? Tap the like button and click subscribe. It helps us bring more multifamily news straight to you.